Let me present Chapter 4, entitled Job Loss Insurance, from Actuarial Foundations for Life and Health Insurance. The objective of this chapter is to move from classical life contingencies to a form of insurance where the insured event is not death, but the loss of employment. This change is important because it introduces a reversible risk process. A person can lose a job and later return to employment. The chapter therefore prepares the ground for richer multi-state actuarial models, while remaining simple enough to keep the actuarial mechanisms transparent. Throughout the presentation, I will emphasize 4 ideas. First, the contractual context matters, especially for mortgage loan insurance, where unemployment can threaten the ability to repay principal and interest. Second, the mathematical model must distinguish being unemployed at a given date from being continuously unemployed for a given duration. Third, pricing and reserving must explicitly account for waiting periods, deductible periods, and the possible return to employment. Fourth, the estimation of transition rates relies on exposures and observed transitions in the same spirit as mortality estimation, but with 2 opposite transitions instead of a single absorbing transition. The first part of the presentation gives the general overview of the chapter. We begin with the actuarial motivation and with the 2-state representation of the employment history. We then introduce the transition rates, transition probabilities, duration probabilities, and counting process formulation. The second part turns to valuation with premiums, benefits, pure single premiums, and reserves. The last part explains how the process can be simulated and how the transition rates can be estimated from exposure data. The chapter develops an actuarial model for insurance contracts that compensate the financial consequences of involuntary job loss. The key contractual example is mortgage loan insurance, where a borrower may suddenly lose income but must continue to meet loan payments. The insurer may then cover all or part of the loan installments for a limited period. Unlike mortality insurance, the insured event is not final. The employment history is represented by a 2-state process with an employed state and an unemployed state, and transitions are possible in both directions. This reversibility is the central technical feature of the chapter. A person who is unemployed today may return to employment later, and a person who is employed today may become unemployed later. As a consequence, it is no longer sufficient to know the state occupied at 2 dates. One must also know whether the insured has remained continuously in that state, especially when benefits depend on unemployment duration. This explains the distinction between transition probabilities and duration probabilities. The chapter then incorporates the contractual restrictions used in practice: waiting periods to reduce adverse selection, deductible periods to avoid covering very short unemployment spells, and maximum payment durations. Pricing and reserving combine these clauses with the probability of job loss, the probability of remaining unemployed during the deductible period, and the possibility of reemployment. The reserve is therefore state-dependent, and in the unemployed state, it also depends on the duration already spent unemployed. Finally, the chapter shows how job loss and reemployment rates can be estimated from observed transitions and exposures, and how crude estimates may be smoothed by Poisson regression. We now enter the first technical part of the chapter, where job loss insurance is described as a 2-state model. The essential point is that this model looks simple visually, but it is not equivalent to the single life mortality model. In mortality, death is absorbing. In job loss insurance, both states communicate with each other. This single difference changes the meaning of probabilities, the role of unemployment duration, and the structure of reserves. Job loss insurance is usually sold in a very concrete financial context. A typical case is a mortgage loan. The borrower has taken out death and disability insurance, and job loss cover is added as an optional rider. If unemployment occurs, the borrower generally experiences a reduction in income but still has to repay principal and interest. The insurer may therefore step in and cover loan payments for a specified period. The chapter explains that in France, eligibility is usually restricted. The borrower must generally be employed under a permanent contract, have completed a minimum service period with the same employer, not be on probation, not be under notice of dismissal, not have resigned, and be eligible for unemployment benefits. Age limits are also frequent. often around 55 to 60 years. These restrictions are not merely administrative details. They respond to strong information asymmetries. The insured often knows more than the insurer about the stability of his or her job. Moreover, unemployment involves behaviors and search efforts that are difficult to observe. Insurers therefore use contractual clauses to reduce adverse selection and moral hazard. Waiting periods prevent someone who already anticipates job loss from buying immediate protection. Deductible periods prevent the insurer from covering very short unemployment spells, which may be absorbed by public benefits or savings. Maximum indemnity periods limit the exposure per spell and over the whole contract. Finally, unemployment is partly non-diversifiable. During a recession, many policyholders may lose their jobs at the same time, so pooling is weaker than for independent individual risks. This explains why the chapter links job loss insurance to credit insurance and to the need for equalization reserves. The diagram shows the entire state space used in the chapter. The insured is either employed, denoted by E0, or unemployed, denoted by E1. The important visual feature is the two-way movement between the states. A job loss moves the insured from employment to unemployment, while re-employment moves the insured back from unemployment to employment. This two-way structure is the reason why the model cannot be treated as a simple absorbing model. It also explains why actuarial quantities must be able to follow repeated employment and unemployment spells over the life of the contract. The employment history is described by a stochastic process indexed by time since policy inception. At time 0, the insured enters the contract while employed and aged X. At any later time, the process indicates whether the insured is employed or unemployed at age X plus the elapsed duration. This notation is deliberately close to the notation used earlier for single life insurance, but the interpretation is different. In the mortality model, once the process reaches the deceased state, it never leaves it. Here the process may alternate between employment and unemployment several times. This is why the chapter introduces a second process, the duration process. At each date, this duration records how long the insured has already spent in the current state. The definition is path-dependent. It looks backward from the current time and finds the length of the most recent uninterrupted stay in the present state. This variable is essential for job loss insurance because benefits rarely depend only on the fact that the insured is unemployed today. They often depend on how long the current unemployment spell has lasted. For example, the insurer may pay nothing during the deductible period, begin payments only after 3 or 6 months, and stop after a maximum indemnity period. The event of being unemployed with duration Z therefore means more than being unemployed at a given age. It identifies the current spell and determines whether the contractual conditions for payment are satisfied. This distinction between state and duration will reappear in the premium and reserve formulas. We now introduce the transition rates that drive the process. They play the same conceptual role as the force of mortality in single life insurance, but there are now two forces instead of one. One force measures the instantaneous intensity of job loss for an employed insured. The other measures the instantaneous intensity of return to employment for an unemployed insured. The two limits displayed on the slide define the instantaneous transition rates. The first one is the job loss rate. It measures the instantaneous risk that an employed insured becomes unemployed immediately after age X plus T. The second one is the re-employment rate. It measures the instantaneous chance that an unemployed insured returns to employment immediately after that same age. These rates must not be interpreted as probabilities over a finite period. They are local intensities conditional on the state occupied just before the transition. Over a very small time interval, the probability of changing state is approximately the relevant intensity multiplied by the length of the interval. Conversely, the probability of remaining in the current state is approximately 1 minus that same product. This is exactly the local structure summarized by the Taylor expansions shown on the slide. The notation uses the index A for the active or employed state and the index C for the unemployed state. Thus, the transition from A to C is a job loss, while the transition from C to A is a return to employment. The chapter emphasizes that at this stage, the re-employment rate is assumed to depend only on age and not on the unemployment duration already accumulated. This is a simplifying assumption. In real labor markets, the probability of finding a job may decrease with unemployment duration because of skill depreciation, employer screening, or discouragement. Duration dependence is therefore actuarially important, but it is postponed to more advanced multi-state models. The formulas shown on the slide are obtained under the assumption stated in equation 4.1. Both transition rates are constant within each integer age interval. This assumption is very common in actuarial modeling because observed data are often organized by integer ages. It allows continuous time transition probabilities to be reconstructed from annual rates in a tractable way. The first expression gives the probability that an insured who is employed at the beginning of the age interval is employed again after T years. This probability includes two types of paths. The insured may remain employed throughout the period, or may lose the job and return to employment before the final date. This is why, in a reversible model, it is a transition probability rather than a duration probability. The second expression gives the probability that an initially employed insured is unemployed at time t. The structure of both expressions reflects the competition between the two rates. The sum of the job loss and re-employment intensities determines the speed at which the process moves toward its short-term equilibrium distribution. Equations 4.2 and 4.3 provide these probabilities when the initial state is employment. Equations 4.4 and 4.5, developed in the chapter, give the corresponding probabilities when the initial state is unemployment. For longer periods, crossing several birthdays, the rates may change from one age interval to the next. The chapter therefore builds the transition matrix by multiplying fractional year and full year matrices across successive integer ages. This slide introduces one of the most important conceptual distinctions in the chapter. A transition probability only describes the state occupied at the beginning and the state occupied at the end of the period. It says nothing about what happened in between. For example, an insured employed at time S and employed again at time t may have remained employed continuously, but may also have become unemployed and then returned to employment before t. By contrast, a duration probability requires uninterrupted occupation of the same state over the whole interval. For the employed state, it is the probability of no job loss during the period. For the unemployed state, it is the probability of no return to employment during the period. In the earlier mortality and disability models, same-state transition probabilities often coincided with duration probabilities because the relevant transitions were one way. Once a state was left, it could not be re-entered. In job loss insurance, this is no longer true. Same-state transition probabilities are larger than or equal to the corresponding duration probabilities because they allow paths with an even number of transitions. The two expressions shown on the slide explain how duration probabilities are obtained from the transition rates. They are survival-type probabilities. Remaining continuously employed is governed by the accumulated job loss intensity, while remaining continuously unemployed is governed by the accumulated re-employment intensity. This distinction is crucial for deductibles because the insurer must know whether the current unemployment spell has lasted long enough, not merely whether the insured is unemployed at the payment date. The chapter then introduces probabilities with retention in the terminal state. These quantities refine ordinary transition probabilities by adding a condition on how long the insured has remained in the state occupied at the final date. They are useful when payments depend on the duration of the current spell. The derivative shown on the slide is best understood by decomposing the path at the last transition into the terminal state. To be unemployed at the final date with a terminal duration equal to V, the insured must first be in employment just before the last transition, then experience a job loss at the appropriate time, and then remain continuously unemployed until the final date. This path decomposition explains the three factors in the derivative: a transition probability before the last jump, an instantaneous job loss intensity at the jump time, and a duration probability after the jump. The same logic applies to the other possible combinations of initial and terminal states. The second part of the slide gives the counting process representation. The process can be described by two counters, one for job losses and one for returns to employment. Their stochastic intensities are obtained by multiplying the relevant transition rate by the indicator that the insured is currently exposed to that transition. A job loss can occur only if the insured is employed just before the date, while re-employment can occur only if the insured is unemployed. This representation leads to a Dubmeier decomposition with martingale innovations, which separates predictable transition accumulation from random timing. We now turn from the stochastic model to actuarial valuation. The objective is to compute premiums and reserves when benefits are paid only under specific contractual conditions. In job loss insurance, valuation cannot be based solely on the probability of being unemployed. It must also take into account the date of job loss, the duration already spent unemployed, the deductible period, the waiting period, the expiry date, and possible re-employment. The valuation model introduces three contractual parameters. The first is the contract duration, denoted by N. The second is the waiting period, denoted by gamma. The third is the deductible period, denoted by F. The waiting period starts at policy inception. During this initial period, the insured is not entitled to compensation in the event of job loss. More importantly, a job loss occurring during the waiting period is not covered even if the unemployment spell continues after the waiting period ends. This clause is designed to reduce adverse selection, especially when the guarantee is optional. It prevents individuals who already anticipate a short-term dismissal from immediately transferring the risk to the insurer. The deductible period operates differently. It begins after a covered job loss. During this period, no benefit is paid, and there is no retrospective coverage for installments due between the job loss and the end of the deductible period. For mortgage loan insurance, the chapter indicates that waiting periods often range from 6 to 12 months, while deductible periods often range from 3 to 6 months. If job loss occurs after the waiting period, but too close to the end of the contract, benefits may never start before expiry. This explains why job losses after N-F are naturally excluded from premium paying exposure. Once benefits start, they continue only while unemployment persists and only until the contract expires. In practice, additional maximum indemnity periods per spell and over the whole loan duration may also be imposed. Premium payments are represented by a cumulative payment function for an insured who is employed. The central actuarial convention is that premiums are due only while the insured remains in the employed state. The expected present value on the slide therefore combines three ingredients: the discount factor, the probability of being employed at the payment date, and the premium payment measure. Because of the deductible period, the chapter argues that it is natural not to require premiums after time N-F. A job loss occurring later could not lead to compensation before the contract expires. Benefits are described by a function depending on both calendar time and unemployment duration. This is necessary because a payment at time t may depend on when the unemployment spell started. The chapter gives two examples. In mortgage loan insurance, the benefit may correspond to the loan installments paid by the insurer while the borrower is unemployed. If the loan is repaid by constant annuities, the benefit count depends on the number of payment dates falling after the deductible period and after the waiting period. In an unemployment annuity, the insurer may pay an income stream whose amount decreases over time, for example linearly. In both cases, the benefit is paid only if the spell has survived the deductible period and if the job loss occurred after the waiting period. The general expected present value of benefits is therefore built by integrating over possible job loss times and future payment dates, while imposing survival in unemployment between these dates. The pure single premium shown on the slide is the expected present value of the insurer's future unemployment payments under the waiting period and deductible period clauses. Rather than reading the formula mechanically, it is better to interpret its construction. The outer integration considers all possible covered job loss times. It starts after the waiting period because earlier losses are excluded and stops at N-F because a later loss cannot survive the deductible period before contract expiry. For each possible job loss time, the model first requires the insured to be employed up to that time. Then the job loss intensity gives the instantaneous probability of entering unemployment at that date. The next factor requires the insured to remain unemployed throughout the deductible period. If re-employment occurs before the deductible has expired, no benefit is paid for that spell. Conditional on survival in unemployment up to the end of the deductible period, the inner integral values all future benefit payments until contract expiry. Each payment date is weighted by the probability of remaining unemployed from the end of the deductible period to that payment date and by the appropriate discount factor. This structure is very close to the actuarial principle of conditioning on the time of the insured event, but adapted to a reversible process and to duration-dependent payments. Under the principle of equivalence, this pure single premium can then be converted into a continuous premium rate or into periodic premiums. The denominator is the expected present value of premiums paid while the insured is employed and before time n-f. The reserve is the expected present value of future benefits minus the expected present value of future premiums, conditional on the information available at the valuation date. In this chapter, the reserve cannot be described by a single function of time. It must depend on the current employment state. If the insured is employed at time t, the reserve for the active state values future job losses that may occur after t, together with the premiums still payable while the insured remains employed. If the insured is unemployed, the reserve also depends on the duration already spent in unemployment. This is because the current spell may already be beyond the deductible period, may still be waiting for the deductible to expire, or may not be covered if it started during the waiting period. The expression on the slide decomposes the unemployed reserve into three parts. The first part, denoted by the current spell component, values benefits attached to the unemployment spell already in progress. The second part accounts for the possibility that the insured returns to employment at a future time. If that happens, the contract re-enters the active state valuation, and the relevant future reserve becomes the employed reserve at the re-employment date. The third part subtracts future premiums that may become payable after re-employment. This decomposition is actuarially useful because it separates the value of the current claim from the value of future insurance coverage. It also shows why duration-dependent benefits make the reserve structure more complex than in the basic single life model. The final technical part concerns implementation. Once the transition rates are specified, the employment process can be simulated through successive sojourn times in the employed and unemployed states. Conversely, when portfolio data are observed, the transition rates must be estimated from the number of job losses, the number of returns to employment, and the exposure time spent in each state. The two differential relations shown on the slide are Thiele-type equations for the simplified case where benefits do not depend on unemployment duration and where there is neither waiting period nor deductible period. They express the local balance of the reserve. For the employed reserve, the instantaneous change includes interest earned on the reserve, premiums received, and the financial effect of a possible transition to unemployment. For the unemployed reserve, it includes interest, benefits paid, and the financial effect of a possible return to employment. The transition terms compare the reserve in the arrival state with the reserve in the current state, multiplied by the relevant transition intensity. When benefits depend on unemployment duration, the chapter explains that the differential equations become considerably more cumbersome because the reserve must also track the duration variable. For simulation, the process is represented by transition times and sojourn times. Starting from employment at time 0, one simulates the time spent employed until job loss, then the time spent unemployed until re-employment, and so on. Once a trajectory is simulated, the discounted cost of the cover can be computed directly under the chosen contractual clauses. For estimation, the homogeneous likelihood leads to intuitive maximum likelihood estimators. The job loss rate is estimated by the number of job losses divided by exposure in employment, and the re-employment rate by the number of returns divided by exposure in unemployment. The chapter then proposes Poisson regression smoothing, where transition counts are modeled with means equal to exposure times the corresponding transition rates. The last part summarizes the actuarial message of the chapter. Job loss insurance is an instructive example because the state space is small, but the contractual and probabilistic issues are rich. Reversibility, duration dependence, and aggregate economic risk all appear in a compact model. The chapter shows that job loss insurance cannot be reduced to a classical one-way contingency model. The two-state representation is simple, but the transitions are reversible. An insured can move from employment to unemployment and later return to employment. This feature immediately changes the actuarial quantities needed for pricing and reserving. In particular, duration probabilities and retention probabilities become essential. A contract does not merely ask whether the insured is unemployed at a payment date. It asks whether the current unemployment spell started after the waiting period, whether the deductible period has expired, and whether the maximum payment duration has been reached. Pricing must therefore integrate over possible job loss times and future payment dates while conditioning on continued unemployment during the relevant intervals. Reserving must distinguish the active state from the unemployed state. And in the unemployed state, it must also depend on the current spell duration. The chapter also stresses that job loss insurance has a portfolio dimension that is more delicate than for many individual life risks. Unemployment is strongly affected by macroeconomic cycles, and job losses may become highly dependent during recessions. This partial non-diversifiability requires careful portfolio management, possible factor models describing the economic environment, and equalization reserves to absorb adverse periods. Finally, the chapter points to practical extensions, such as deferral insurance for mortgage loans, where the insurer covers interest while principal repayment is postponed. Overall, the chapter provides a bridge between life contingency techniques and broader multi-state insurance models with economic dependence.